In a shocking turn of events, the United States banking sector is facing a crisis of confidence, resulting in a sharp decline in bank shares. Investors, shaken by the gravest series of banking failures in America since 2008, are urgently abandoning smaller lenders perceived to be on the brink of the next potential collapse. Shares in California-based PacWest plunged 50%, while Western Alliance also tumbled nearly 40%. Starting with the collapse of Silicon Valley Bank in March, regional banks have faced a sharp decline. Rising interest rates, pressure to increase rates on customer deposits, and reduced market value of assets due to higher rates are contributing to the turmoil. The sell-off intensified after First Republic was seized and sold to JP Chase. Bank of America's second quarter revenue fell 4% to $21.5 billion, with total loans down 12%, while Citigroup reported a 12% slide in total revenue. The number of Americans facing financial trouble with their auto loans is on the rise, and this is adding to concerns about a banking crisis. Recently, data from automotive research firm Edmunds.com revealed that the number of Americans with auto loans in negative equity reached an average of $6,054 in November. This negative equity is the highest level since April 2020. It means that many people owe more money on their car loans than the actual value of their vehicles. A concerning statistic is that the percentage of subprime auto borrowers who are at least 60 days past due on their car loans reached 6.1% in September. This is the highest level ever recorded, surpassing the figures seen during the peak of the 2008 financial crisis. As more people struggle with their auto loans, it puts additional pressure on banks, which are already dealing with various challenges, contributing to an overall sense of unease in the banking sector. American banks are also bracing for a significant increase in losses, as evidenced by a 43% surge in loan loss provisions from the first to the second quarter, reaching a combined total of $36 billion. Despite substantial government aid and support measures, banks anticipate a surge in credit defaults and soured loans. Although the banks have implemented forbearance and deferred loan repayments, they acknowledge the impending challenges, with experts noting the bank's preparation for potential economic turmoil. There's a prevailing unease in the banking sector, despite reassurances from bankers and regulators. JP Morgan's Dimon and Federal Reserve Chair Powell have tried to convey that the worst of the crisis is over, but investor concerns persist. Smaller regional banks like PacWest and Western Alliance are facing sell-offs, with PacWest considering a sale due to a concentration of large uninsured deposits from venture capital and tech clients. Even Midwest regionals like Comerica and KeyCorp are down over 20%, possibly reflecting concerns about real estate loans in the office property market. The Federal Reserve's fight against inflation has contributed to banking turmoil, with a recent interest rate hike affecting depositors' behavior. Higher rates prompted a shift to higher-paying instruments, impacting the tech industry and exacerbating the challenges faced by banks like Silicon Valley. The collapse of 3 large banks in 6 weeks has led to expectations of tightened lending and continued pressure on bank stocks. Regulatory uncertainties and economic concerns further contribute to the challenging landscape for the banking sector. The timeline of the United States banking crisis. Even though the American banking crisis is predominantly 2023 focused, the broader timeline spreads back to 2019. Let us delve deeper. In 2019, the Fed changed the stress testing norms, or the tailoring rules for the banks, lowering the liquidity standards for institutions holding assets under $100 billion. Then in October 2022, global interest rates surged, making it harder for banks and even investors to borrow money. In January 2023, banks like FRB and Signature Bank started seeing massive capital outflow as investors started pulling out money to fund standard operations. This furthered the financial market instability, bringing in initial signs of a liquidity crisis. In March 2023, the banking sector faced a significant crisis, starting with the sharp decline in SVB share prices, causing a $52 million market value loss for major institutions like Bank of America, JP Chase, Citigroup, and Wells Fargo. Regulators took control of SVB and Silvergate, heightening systemic risk concerns, and by March 12th, regulators assured customers that their deposited funds were secure. The crisis extended globally by March 15th, with European banks like Credit Suisse, BNP Paribas, and Deutsche witnessing share price drops. First Republic Bank received a junk credit rating, and SVB Financial filed for bankruptcy protection on March 17th. Debt delinquencies. In a financial turmoil tale that reads like a thriller, Silicon Valley Bank and Signature Bank have recently crumbled under the weight of massive withdrawals, igniting concerns that regional United States banks might be next. Depositors are hastily shifting their money from regional banks to money market funds, allured by better returns and a sense of security. But this massive exodus raises an unsettling question. Are we on the brink of a bank run epidemic that could trigger a severe credit crunch? The storm worsens as corporate bankruptcies surge and consumer debt delinquencies skyrocket across all categories, leaping from 0.16% in 2022 to a troubling 0.25% in 2023. Higher loan costs. The central bank has increased interest rates drastically, bringing the total increase in borrowing costs in America since the 1980s to as high as 5% from almost zero this year. This action seeks to slow the rate of inflation spike. Raising interest rates contributed to Silicon Valley Bank's demise by devaluing its securities portfolio. They have also raised worries that other medium-sized and smaller institutions would face comparable dangers, which could result in deposit withdrawals. Since the Federal Reserve has also started raising interest rates this year, depositors have taken out about $1 trillion from the most vulnerable American banks. Massive withdrawals. Depositors' concerns regarding the security of their money are growing as news of bank failure spreads. The banking system has become less trustworthy as a result of a number of problems, including speculative investments, reckless behavior, and interruptions in interbank lending. Customers are withdrawing their money in response to realizing that their banking institutions are facing serious difficulties. The increase in withdrawals is a reflection of depositors' underlying resentment and irritation, as they anticipated a dependable and safe banking environment. The outrage sparked by the notable and frightening failures inside the banking sector is the reason for the rush with which they need to protect their financial assets. Cybersecurity issues. As of the latest reports, the United States is grappling with a surge in cyber attacks on banks, leading to severe consequences for the financial sector. With more people using digital services, hackers see banks as attractive targets. In recent months, several banks have experienced actual cyber attacks, leading to financial losses and disruptions in their operations. These attacks have resulted in the compromise of sensitive customer information, causing a significant erosion of trust among account holders. According to recent industry reports, there has been a 40% increase in ransomware attacks targeting financial institutions in the past 6 months. Additionally, the financial losses incurred by banks due to cyber incidents have surpassed $500 million this year alone, underscoring the urgent need for enhanced cybersecurity measures. As a result of these incidents, customers across the country are expressing heightened concerns about the safety of their financial assets and personal data. This has led to a surge in account closures and withdrawals of funds by consumers. Financial sector's weaknesses. In retrospect, it's evident that the financial industry started showing signs of a number of weaknesses prior to 2023. Among these are financially troubled banks that have made large investments in riskier businesses, prioritize excessive gaming, and have interbank money lending issues. In addition to making it difficult for banks to satisfy withdrawal requests, these problems also introduced a number of concerns. Notable mistakes have been made in risk management and control. American bank clients are extremely outraged by these issues and are worried about the stability and dependability of the financial institutions. Payment processing glitches. America's major banks have been hit by deposit delays following a glitch at a payment processing network, leaving customers unable to get paid. The Wall Street Journal noted that approximately 900,000 payments were affected by the issue. The Federal Reserve said that the glitch is due to a processing issue at the private sector operator of the Automated Clearinghouse, a national network for processing transactions. The cumulative effect of these glitches across various banks has been substantial, with reports indicating that over 15 million customers have been directly affected by payment processing issues in the past month. The financial losses associated with these incidents have surpassed $30 million, leading to concerns about the reliability of digital payment systems. Regulation and compliance issues. Stringent regulatory requirements imposed on banks, especially after the 2008 financial crisis, have increased operational complexities and costs for financial institutions. Compliance with these regulations often involves extensive paperwork, audits and reporting, diverting resources away from core banking functions. Additionally, the ever-evolving regulatory landscape requires continuous adaptation, putting further strain on the industry. For instance, Comerica Bank has acted as a financial agent for the Treasury Department's Direct Express program, but is currently under fire for breaching one of the fundamental rules of the program. Comerica documents reveal that the bank allowed personal information on program participants to be shared and handled by a Redwood City, California vendor, with an office in Lahore, Pakistan, in violation of the program. The pressure from regulatory bodies has intensified, with frequent updates and stricter enforcement, making it challenging for banks to maintain compliance. Commercial lending. The banking sector has witnessed a surge in non-performing loans, creating a strain on the financial health of several banks. According to recent data, the default rates on commercial loans have spiked, reaching the highest levels in the past decade. This trend is alarming for both large and small banks, as it directly impacts their balance sheets and overall stability. The growing uncertainty in commercial real estate and other sectors has resulted in a wave of defaults. In the face of the ongoing banking crisis, American banks can tackle the bad news by being open and honest with their customers and investors. Sharing clear plans on how they're fixing the situation and working closely with regulators is essential to rebuild trust. Being ready for challenges and staying open to new ideas can help banks bounce back and make people feel more confident about the banking system. Comment down below on what you think, and leave a comment if you find value in the content we do on this channel. Hit the subscribe button for all the latest updates, and we'll see you in the next video.